And once again, I forgot to press record. But thank God I didn't do the entire video without the record button on, because that's happened before. What's up, advocates, and welcome back to another episode of the Commercial Claims Show. I'm your host, Vince Perry, licensed and certified public adjuster in the state of Florida, and I'm glad to be back because we are officially in the new year. It is rolling, week 2 of the new year.
Merry New Year!
And I don't know about you guys, but I've been moving and shaking, baby. I've been hustling, I've been getting it going, meeting different people, trying to just take it to the next level, because no matter what level you're at, you could always take it to another level, okay? There's always more that you could accomplish. There's always more that you can do. So I'm feeling good. I'm feeling good. So today I got a great message from someone on Instagram, and they were asking me about all the crazy acronyms that are going on here.
Here's Johnny!
Now this, I'll tell you, it's a very beginner's video here, so just FYI, for those of you that have been doing this for a while, you're probably not going to get much from this video, so you can press stop now. Goodbye. See you next week.
Take care now. Bye-bye then.
But if you are new, and relatively new, if you are, I'd say, just a year or two, or even maybe a little bit more, you might get something, because there's a couple of them in here, a couple acronyms in here that even I remember took me a while to really understand. So I'll do my best to help you understand. I'm just going to tell you basically what they mean, what they stand for, number one, and just sort of what they mean too, and give you, but there's a couple in here that I might get a little bit in depth with. So the ones I'm going to be going over, just so you know, and I'm just going to say the acronyms are RC, ACV, ALE, EMS, ABC and D, HODP, O&P, LOU, and GCA. Whoa! Did you get all that? I'm pretty sure I hit almost every letter in the alphabet there, except X, Y, and Z. But you know, let's see. Like I said, if that's too elementary for you, then well, so be it. But you know, okay. So, first one, RC. I'm gonna give you these are gonna be the tough. This is the toughest one, in my opinion. The difference between RC and ACV. RC means replacement cost. ACV means actual cash value. Those of you who have done some claims already, have you noticed that when the estimate comes in, you see a little number underneath the amount of the estimate that knocks out a big chunk of that estimate? It's called recoverable depreciation. I guess we call that RD. Recoverable depreciation is what they take out of the estimate, and you're just like, well, what the hell? If you wrote an estimate for $50,000, why are you taking away $5,000 or $4,000 or $10,000 or $11,000? That's not cool. And then you see the deductible, and then you see even at the bottom of that, you'll see once depreciation is recovered, this is what you'll end up with. So they try to make it sound all like, oh, look, don't worry, we're pretending to take this out, but we're not really going to take this out, but then we're actually going to take it out. You know, that's not cool. Well, that's what they're taking out is called recoverable depreciation, and that is basically determined by RC, replacement cost, ACV, actual cash value. So what that means is you'll have clients that will say, well, I have a replacement cost policy, so therefore I should get full value. And yes, you do. Whether you do or whether you don't, you most likely have a replacement cost value. Most replacement cost insurance policy, most policies are, but what they do is they don't give you that up front. What they do is, here's what they do. So you have your replacement costs, you have your actual cash value. I'm laughing right now because I'm already feel like I'm confusing a lot of people.
Yes? Yes?
I don't get it.
Because this is the one that took me years to really understand. Okay, so if you have a tile floor, okay, and that tile floor you've had that tile floor for 15 years in your house. Okay, well that tile floor has depreciated in value, obviously, right? Not just because it's 15 years old, but also because people have been walking on it for 15 years. You've probably cleaned it a million times and shined and buffed it or do whatever it is that you do with your tile. You've dropped things on it, you've broken stuff on it. So what happens is, over the years, it depreciates in value. It's not worth the same. Even with inflation and all these things, it's not. If you were to put brand new tile on there, you're basically technically putting on something newer, something better. So what they do is they take away the depreciation, and the depreciation is just an amount that's calculated that over time that tile floor loses its value. So what the depreciation is exactly how much value that has lost. Well, not exactly, according to the estimating software that the insurance company is using. So if that tile floor was worth $5 a square 15 years ago, it may only be worth $3.50 per square now, after being walked on, things being dropped on, it being cleaned, so on and so forth. So what they pay you for when you get paid on that claim, well, so if it was worth $5, if new ceramic tile flooring is worth, let's say, $5 per square foot, but because your tile is 15 years old, it's now worth $3.50, that is the actual cash value. The $3.50 is the actual cash value of what your tile is worth. So they're going to pay you the actual cash value of what your tile is worth. They're not going to they're not going to pay you for the replacement cost. The replacement cost is what the tile costs today. So in the estimating software, it says it's $5 for brand new tile. That's what it costs to replace it. It's $5. But because your tile is 15 years old and your tile is only worth $3.50, that is the actual cash value, and that is what we're going to pay. Did you get that?
Yes.
I still don't get it.
I know, it's a lot. So that's what the actual cash value is. It's what your tile is worth now 15 years later. The replacement cost is what tile is worth now in the store, but your tile that's been laid down and used and abused is only $3.50. That is the actual cash value. The replacement cost is what it costs in the store. Okay? Now that doesn't mean that your client or you or anyone's not going to get that back. Okay? You take the money from the insurance company, you get the repairs done, you send some photos to the insurance company, and they'll release that check. They'll release that depreciation. They will release the replacement cost difference of it. You just need to get the work done, or have some invoices, some documentation that proves that the work has been done or is in the process of being done, and they will release it. By law, they have to release it. It's really not that difficult. It's a little bit of extra work for you, but it's basically just emailing some photos, some documentation proving that it's been replaced, and it's just an email, and then they just send you the check. So, just FYI.
Jordan fades back, swoosh, and that's the game!
So I hope you guys got that. How long did I spend on that? A good 6 minutes on just replacement cost. I knew that was going to happen. Replacement cost and actual cash value. So I hope you understand that. All right, recoverable depreciation also. Okay, I don't think I have anything else to say there. Same thing goes for tile roof, shingle roof. Same thing goes for any line item at all that is in your home. There's a depreciation amount. Baseboards have been on there for a while. There's a depreciation amount. Kitchen cabinets, granite countertops, tile roofs, shingle roof, anything and everything. The longer that your house has not been touched and has been with the original products or whatever it is, it's been with the original stuff, it gets depreciated. So, yeah, hope you got that. But you do get it back. And tell your client you do get it back. So if you get paid $50,000 and you see $11,000 depreciation, you can tell your client, hey, we're gonna get this. Okay, so don't think I only got you 30-something thousand. I got you more. We're gonna get this once we start doing some work here. So, okay, moving on. EMS. Oh, I skipped one. Whatever. EMS. Emergency Mitigation Services. This is the water mitigation companies. This is the dry out companies. EMS is the companies that come out to mitigate the damages, to set up the blowers, set up the dehumidifiers, set up the air scrubbers, to set all that stuff up to make sure that everything gets dry the correct way. Mold guys are considered some EMS guys too, but mainly it's the dry out companies that come in. Oh, and they clean up all the fires, so on and so forth. The content people, they could sort of be considered EMS people also, but you know, it's a little bit different, but it's kind of the same thing. So Emergency Mitigation Services is what EMS stands for. ALE, my favorite. Additional Living Expenses. Additional living expenses is the amount of money that the homeowner will need in order to move to another place while repairs are being done, or while they're cleaning it out, or after a huge loss they just need to get the heck out of there. That is ALE, additional living expenses. Another thing related to ALE is LOU, loss of use. Loss of use is more specific to commercial claims and to rental properties. Rental properties where I own a property that you're renting out in and a loss occurs. If I need you to go, the loss of use, I'm sorry, is by you not being able to live on my property anymore. That's a loss of use, and that's basically I get back my rental value. So fair rental value is another one. Is that another one? Oh, now I sound like an idiot.
I'm an idiot.
Well, yeah, basically that's what it is. Loss of use is also the fair rental value. So the amount of rent that it costs for me to rent out the house to you and you can't live there anymore, I'm losing rent because of that loss that occurred. I get paid back for that. So loss of use, ALE, and fair rental value, it's all sort of the same thing, okay? It's basically the home or the building that suffered a loss can no longer be in use and therefore needs to be paid for while it's not there. Again, I'm going off topic here, but not really. Business income is another thing. If you own a building and there's a business, let's say there's a, I don't know, a Chipotle in there, and that Chipotle can no longer be there while everything's getting done. A Chipotle is losing money, but not just a Chipotle, but also you as an owner, who they pay you a lease every month. That's loss of business income. So I'm getting totally away from the acronyms. That'll be for another video. Okay, you got it. So we got RC, we got ACV, we got ALE, we got EMS. What about A, B, C, and D? All right, that's simple. I've explained this in past videos before. You got coverage A, you got coverage B, you got coverage C, you got coverage D. Coverage A is your dwelling. Take your home, take your building, and everything that's stuck to it. Okay, that's basically under your coverage A. Okay, so you turn it upside down, a lot of things fall out. Everything that sticks to it, the kitchen cabinets, the paint, the walls, the baseboards, right? The roof, even though it wouldn't fall out, but still the roof and all the walls. Sorry, always happens. That is under your coverage A. That is your dwelling. Dwelling, just the structure of it, okay? Coverage B is your other structure. So in a home, you have other structures. You have your structure, which is coverage A, your dwelling. Anything that's not attached to your home, that is called other structure. So what I tell people, a lot of times people don't have any other structures. There's nothing that's not attached to my home out there. I said, well, if you were to get a shed, or you were to get, I don't know, just something out there, that would be considered under other structures. Coverage C is your personal property. Take your dwelling, turn it upside down. Everything that falls out, that is your personal property. And then coverage D we just went over, which is ALE, additional living expenses. HODP, homeowner's dwelling policy. Homeowner's policy is if it's your home and you're living there. Dwelling policy is for a home that you rent out to someone. That's basically it. You have the HO1, HO2, HO3. You have DP1, DP2, DP3. It's basically the same thing. The only difference is you have a renter, you own it, and you live in the home as the insured. O&P, overhead and profit, okay? Anytime you hire a contractor to do any kind of work to your home, they will always charge you overhead and profit. Overhead is what they pay all their employees and their office expenses and everything else. I'm not a contractor, so... profit is just the profit that everybody needs to make, and it's always 10%, 10%. So you got 10% of whatever the total value of the whole thing is to do all the repairs. 10% goes to their overhead, 10% goes to their own personal profit. Okay? It is included in your estimate of repairs. I believe it's not included in some other ones. I know that's a big thing on Facebook groups, but it is, at least in Florida, it is included in all repair estimates. Overhead and profit must be included. So, I already went over LOU. GCA. GCA, this is a good one. This one I didn't know for a while. But I would negotiate with carriers, and they'd be like, well, we'll settle for $30,000 total GCA. And I'm like, all right. Kind of knew what it stood for, but I didn't know what the actual thing stood for. Well, GCA stands for gross calculated amount. It's basically just a gross calculated amount of the claim. So $30,000 total GCA is the gross calculated amount that the whole claim is worth. And that's after you're negotiating. So the insurance adjuster could say that the loss is $30,000 total GCA, but you might be saying that the loss is $50,000 total GCA. And then that's where you negotiate on a total GCA. So you could try to, if you'd like, you could try to sound like you know what you're doing, when the next time you're negotiating, you could say, oh, well, we'll settle for $30,000 total GCA. See what they say. I'll be like, ooh, maybe this guy actually knows what he's doing. I better pay up, hopefully. So that's GCA. That one took me, I always knew, it's always obvious what it is when they're talking about it. I'm like, what the heck does it stand for? So it's gross calculated amount. Shorter video today because I can't really think of much other ones to think about. I was also going to talk about ordinance and law, because it's just I was going to talk about different terms and stuff. Ordinance of law, just for your information, if you don't know, is if you need to pull any kind of permits. So if in your estimate you're replacing windows, you're going to probably have some ordinance. They're going to have to pull permits for that. Or if there's any kind of additions or anything like that, or any exterior walls that were affected and that need to be sort of torn down and restructured again, well, there's going to be some ordinance of law. So keep that in mind when you're doing any kind of negotiation. They say, hey, look, we're going to be coming back later when permits are pulled to get this, because you have up to 25% of coverage paid for that. So that is all, my friends. There's nothing else to say, but follow me, subscribe. Let's keep this train rolling. All right, coming out with a new video every single week. I guarantee it. Maybe some additional ones here and there. That's my goal. But for the most part, that's pretty much it for today. Subscribe to the channel. Please share this video whenever you can. Please keep sending me your comments. They're, for the most part, very positive. I haven't really heard much negative, but please keep sending me your comments. Even if they are negative, I prefer to even hear those, because that's how we can improve here. Send me messages with any kind of questions on Instagram, right? I probably already put that. Instagram, Facebook is the best ones to do it, and that's pretty much it. We've got a web page, a better web page coming up pretty soon here, but that's not yet. All right, get out. See you later. Bye.